Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate 360 is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. Or via the web at realestate360live.com. That's realestate360live.com. So back to this week's market movers. Obviously, I had said that, we have the jobs reports at the end of this week. Also, we want to maintain our focus on what's going on in Europe. There's been a lot of analysts out there, Louis, that have said that we're likely to see a pullback in the amount of money that's actually coming into the safe havens of bonds in the United States. So what that could mean is potentially that, that interest rates might start to slip up a little bit, because when they're, we're getting all this money coming from, China and Europe and everywhere else, because they feel like U.S. is the safe place, and money stops, pouring in here, interest rates could start to drift a little higher. Now, do I think that they're going to drift drastically higher? Probably not. But I do always say that, we're at historical rates right now, historic lows. So, I would hate to see that, just get even a bump of an eighth and a quarter when you could take advantage of them now.
Right now, the rationale, Ryan, is that somehow Europe has done something positive to give more confidence in the euro, and all they're doing is bailing out and spending and printing more money, so therefore they appear safer. Now, that's going to fade, and eventually people will go back to thinking the United States is a safe haven, because the U.S. will also continue to bail out and to print money. Eventually, neither of them is a safe haven, but for now, I think it's just temporary, and I think that the Fed will regain the upper hand in being perceived as a safe haven by doing QE3 or however else they decide to print money. So you're right, interest rates should remain low, or will remain low, not that they should, if they were subject to normal market forces.
Right. And, it was interesting because on Friday, the stock market rallied after the Eurozone political leaders had agreed on steps to stabilize their credit markets and strengthen the regional banking system, but yet they didn't really lay out any plan of how they planned on doing that. And I think this is probably like the 17th or 18th time that they've said that they were going to do something like this.
Well, you know what they're threatening to do? They're threatening to have a Euro-wide financial system, kind of like the Fed, and, Euro-wide like an FDIC program for deposits and so on. I don't know if that's going to go through, but because the economies are so diverse. But, the United States has a similar diverse economy. We mentioned this earlier in the show. The economies of California are much different than New York, are different than the economies of Alabama and Wyoming.
Yeah, I totally agree. They're completely different.
Employment rates are different. The industries are different. And what happened in Europe was, because they joined the Eurozone, the Mediterranean countries were able to get advantage of lower interest rates for their debt, even though the underlying economies didn't deserve to be getting those low euro rates.
Yeah, and you bring up another good point because, in all these different markets, whether it's San Francisco, Washington, D.C., Florida, the real estate markets are completely different as well. And, what we're experiencing here in the Washington, D.C. metro area, which is a very low supply of homes, with coupled with very low interest rates, we're seeing prices that are going up substantially.
Totally different than what you hear the national real estate situation is.
Yeah, when you have the National Association of Realtors saying one thing, and then you're like, okay, well that's what's going on. No, that's actually not what's going on here in the D.C. metro area, and it's important that you're aware of that. And one of the things that I wanted to bring up is that the longer that interest rates stay low, and as long as the employment situation in the D.C. metro area stays somewhat stable, buyers are actually losing the upper hand in the negotiations. And what I mean by that is I've seen more and more over the last probably 2, 3, 4 months that the buyers would typically, ask ask the seller for seller concessions to go towards their closing costs. Well, now since we have a low supply of homes, everybody's out there trying to buy the first home that comes on the market that's decent. You know what? They're having to make full price offers, not able to get the same closing costs. So what that really means is, though, is that the people that are the most qualified or you know, have the most amount of funds to be able to work with, where they don't need any money for seller concessions, they're going to be probably the people that are going to be the premier client that the seller wants to work with. You know, gone are kind of the days, at least in the D.C. metro area again, where, you know, you just go ahead, make a full price offer, ask them for closing costs, and that's the normal thing that would probably take place. They would give them to you. Now, with the low supply of homes, I'm seeing a trend where the sellers are now gaining the upper hand, where we have multiple contract situations like we spoke about last week, Lewis. So this is, you know, from like 4 years ago, we're right back into the same thing again.
And then you question whether things like home staging make sense if someone's going to buy the house anyway.
Right. Yeah, I mean, at this point, it's a supply and demand thing. There's actually not enough homes, or at least not enough move-in ready homes that people are like jumping up and down about for the amount of buyers that are out there that are wanting to take advantage of these low interest rates right now.
And do you have any time on market statistics for your area?
Well, I mean, what I try to do is, you know, obviously D.C. metro area encompasses, you know, D.C., Northern Virginia, and parts of Maryland. But I can tell you that in Northern Virginia itself, I mean, like a lot of these properties are you know, 30 days and less, especially and you go into really nice neighborhoods where subdivisions that are really desirable. I mean, half of them are hopping off in 2 days to a week. I mean, literally, it's like hot potatoes. I mean, just in my subdivision alone, which is a pretty desirable community, I mean, I see a sign not even get in the yard, and it's already sold. So
it's desirable because you live there?
It's just it's a desirable because it's a community with a pool.
No, I mean, people want to live where Ryan Sloper lives.
Not exactly. I wouldn't go that far. I mean, it's a nice community. I mean, I enjoy it, but there's a lot of amenities that come with for families and whatnot. You know, with the pools and different things. So it's one of those family atmospheres, and you know, there's probably, you know, a mix of townhomes and single-family homes within my community, but it's probably over like 5,000 homes. And, you know, when one comes on the market, it's just like everybody's just trying to get into that community. So in those areas, I would say that the days on market, I mean, it could be, obviously it's price range sensitive. So, you know, if you're probably 400,000 and below, they're going to move faster. After you get above 400 going into, you know, the 500 plus, they're going to slow down a little bit. But if their homes are priced right, Lewis, they're still moving just as fast as they should. But I mean, what I'm really experiencing is just a lot of frustration on the buyer's front. Buyers are just like, you know, I just want to move. I want to take advantages. I'm getting tired of paying rent. And I got actually a little chart here. With the source is actually the Joint Center for Housing Studies of Harvard University, where it's basically showing you over the last 20 years what mortgage payments, where they were at, what the payment to income ratios were, and also what the payment to rent ratios are. Now, the prices and mortgage payments are based on the median existing single-family home prices that were averaged from quarterly data to obtain the annual prices, and the mortgage payments are calculated using the interest rate average for that year, and they assume a 20% down payment on a fixed 30-year mortgage. So in 1990, basically that average mortgage payment, the median existing single-family home price with 20% down was $1,183. That payment to income ratio was 28%. The payment to rent ratio was 1.45. Now in 2000, actually the mortgage payment went down to 11.25. The payment to income ratio went down to 0.24, 24%. The payment to rent ratio went down to 1.37. In 2006, the payment went back up, mortgage payment to $1,240. The payment to income ratio went back up into the 1990 levels of 28%. The payment to rent ratio went up to 1.44. Now, it gets really interesting because now we jump ahead to 2011. The mortgage payment in dollars is $669, almost half of what it was in 1990, in 2000, and 2006. The payment to income ratio is 0.15, 15%. And the payment to rent ratio drops down to 0.77, half of what it was before. So now, obviously, they compile these statistics in weird ways, and they probably factor certain things out. But all in all, if you just look at the actual mortgage payment, where it was in 1990 and where we are now in 2011, it doesn't get much more affordable than where we're at right now. And to think that things are going to stay like this for 5 to 10 years is not very likely. Obviously, we know that the Fed plans on keeping interest rates low for probably a period into 2014. Now, just because they plan on keeping things low through 2014 doesn't necessarily mean that interest rates or mortgage interest rates have to stay low. And I think that what's been going on, a lot of these national headlines, people are starting to understand, okay, well, they know that the Fed does have something to do with interest rates, but they're really not sure how that happens. And like we speak about every week, it is a manipulation of the markets. And I just think that, for people that are trying to plan out when they want to buy, they're like, okay, interest rates are great. I think they're going to stay low. We're going to buy in the middle of 2013. Well, that's fine and dandy. But things could change drastically, like on the next presidential election. Obviously interest rates can move one way or the other. When you have storms, when you have the Eurozone, there's a million factors that take place. But the bottom line is, if you look historically where things are at from 20 years ago to now, it's much more affordable. The payment to income ratio at 15% from the mortgage payment divided to what the person's gross income is, that is awesome.
Now, if you look at where the debt levels are globally, you can imagine just one thing snaps, your Lehman type moment, something happens, and then all bets are off on this low interest rate environment.
Yeah, and it's just right back to the same thing. If you're able to, if you have a steady job, if you have the means, if you saved up some money to put a down payment on a home, if you're renting right now and you're watching your rents shoot up year over year, it makes sense to buy. If all things are adding up, you plan on living in this area for at least 3, 4, 5 years, it makes sense to buy. Because, like I said, if you're going to look at things, and when this inflation inevitably sets in, which could be tomorrow, could be a month, a year, 5 years from now, you are going to be locked in at 30-year fixed low rates at sub 4%, depending upon what your credit qualifications are.
At that point, banks are going to try to buy you out your mortgage.
Yeah. It's just incredible. I can't emphasize it enough. We're coming up on a break. When we come back, I'm going to dive into FHA changes its $1,000 collections rule, and I'm going to let you know what that is when we come back. Stay right there.